Hey guys, Sean here. Welcome to my channel. You know, a lot of people today, they are still looking towards the stock market when it comes to investing their money. And it's kind of hard to fault them for doing so, right? The S&P 500, which is the granddaddy of all indexes, has returned an astounding 14% annualized return for the last 10 years. And even though stocks today have never been more expensive with P/E ratios reaching near historical highs, people are piling on more and more into stocks, and it looks like equities might be kind of reaching bubble territory, right? You know, while I can easily take shots at Tesla's crazy PE ratio of over 400, even Coca-Cola, one of the most famous brands in the world, a stable blue chip stock, has a PE ratio of around 28. However, in the past, in 2014, the PE ratio was just hovering around 14 or 15. So what gives? Now, with the Federal Reserve continually pumping money to the system, and with inflation skyrocketing from just 1.4% in January to over 5% since May 2021, people are afraid of their dollars losing purchasing power, right? People are deadly afraid of it. And for the majority of people, right, piling onto the stock market just makes sense, right? You can just take up your Robinhood app and just do a quick few swipes, and there you go, you're in the market already. In fact, today, 50% of all American household wealth is tied up in the stock market, which is dangerously alarming. That means if something were to happen to the stock market, a lot of people in America, a lot of households, and a lot of investors around the world actually will be in a world of hurt. And that's the big thing, right? Nothing ever goes up in a straight line, and there's always the specter of a market crash or big correction that might happen, right? And this is where we need to be prepared, because I believe that a stock market crash at the end of the day is going to be inevitable. It's not whether if it will happen, but it is when it will happen. Now, a stock market crash is nothing new, honestly. Just in the last 25 years, there have been 3 big crashes that saw the market get smashed down by more than 20% from its peak. There were the dot-com bubble crash, where all kinds of technology stocks were overvalued, the 2008 housing crisis, which saw the S&P 500 crash from 50% from its top, as well as the COVID-19 crash, which saw the index drop 1,000 points from around 3,400 to nearly 2,300. Now that's a big drop. But here's the thing. If you were all into the stock market without any diversification, chances are you'll probably be too terrified to do anything, and you'll probably be either sitting down on your losing positions, or you'll be cutting cord. You'll be cutting your losses and running back to cash because fear has taken grip of you. But if you held gold, you would have been able to profit massively from buying opportunities during these big crashes, right? Now let me explain. Gold has traditionally been considered a safe haven asset during times of crisis, right? So it has proven to weather the storm during financial crisis. And while I don't really want to go into all the emotional arguments of gold being used as money for thousands of years, although that is the fact, but let me just go through the hardcore facts, right? So during the 2008 housing crash, while the S&P 500 fell by over 50%, gold also fell, but just around 23%. And after that, it started an amazing bull run that saw it rise from $720 an ounce to almost $1,800 an ounce. And it's really easy to see why. Gold benefits when money suddenly gets printed. Remember the good old days of QE1 of only $600 billion when the Federal Reserve went to bail out the big banks? This flooded the entire market full of liquidity. And when investors saw that, they kind of realized, hey, at the end of the day, the dollar is going to get weakened, and I need to run to an asset which just can't be printed from thin air, which just can't be debased. So I think it's also useful to understand that gold benefits when it comes to the fear trade. When everyone's all fearful of where to place their money, they will tend to take it out from the stock market and they'll place it into safe haven assets, right? It could be real estate, but in this case, we're talking about gold. And this is why people invested into gold. They wanted to preserve their purchasing power, right? Now, the key here is that even though both the S&P 500 and gold fell less, that means that you could buy more shares of the S&P 500 with the same ounce of gold. So just before the crash of 2008, it took around 2.3 ounces of gold to buy a stock of the S&P 500. And after the crash, by February 2009, it took less than 0.8 ounces of gold to buy the same stock in the S&P 500. Now that's a very big whopping gap. It just shows that the S&P during that point of time became undervalued compared to gold, which became overvalued. And this is the point where smart investors, they started to swap one asset for the other. They decided to liquidate some of their gold and put it into the S&P 500, the stock market, right? And when we look back into the pandemic outbreak of, I think around early 2020, the stock market crashed almost 30% within 2 months, while gold actually rose from around 1500 an ounce to a peak of over 1900 within the next 6 to 7 months. Now, you might be wondering, right? Doesn't that mean that I should just buy and hold gold forever? Now, while you can do that, it will come at a price of huge opportunity cost. And let me explain why. Right now, gold has been used as money for thousands of years, but its primary use is to preserve your purchasing power. It won't get you rich. You aren't investing into any company that produces goods and services with the potential for innovation, right? Gold pays no dividends, and just like stocks, putting all your money to gold is just as risky as well. And when it comes to wealth building, the stock market is still superior to gold. You know, from 2008 to today, the S&P 500 performance is around double that of gold, and we're not even going to factor in the dividends that you enjoyed throughout the entire period. And when you reinvest that back into the stock market, the returns really does dwarf that of gold. And in fact, right, if you take a look since 1957 to 2018, right, the S&P gave an annual return of around 8%, which means that if you put in $10,000 in 20 years, you will expect to get back around $45,000, right? However, gold does have periods where the price hardly moves at all, such as between the years 2013 and 2019, which can be rather frustrating for investors who have everything banked into gold. But if you had gold during times of financial crisis, during a stock market crash, you could take advantage of stock market crashes by moving over your purchasing power from gold into buying equities at a discount. So the last few crashes have showed us that during a market crash, even when gold falls, it falls less than the stock market. So this brings us to the power of diversification. If we hold on to too much stocks, a crash will be painful and we won't be able to take advantage of buying stocks at a big discount. And if all we invest is gold, we could lose out our wealth, especially when a time when the economy is recovering and industries are growing, and we don't want to miss out on that growth, which is tied, to people's innovation, companies coming up with new products, new technologies being developed, and this could really see an exponential rise in the stock market. And if you are invested into it, we could actually profit from it as well. This brings us to a bit of a dilemma today, right? And let's face it, no one in the world could actually predict how the stock market is going to move in the next 5 years, in the next 10 years. It could just as easily merrily continue rising for the next 10 years, or it could crash next month. No one actually knows. And the Federal Reserve has been buying around $120 billion of bonds every month, but has called for a gradual taper from December of this year into the middle of 2022. And if that really happens, it could lower inflation and even cause interest rates to rise, which could be bearish for the stock market and very negative for gold. But the tapering might never happen, right? Remember when we mentioned that 50% of the household wealth is in the stock market? Ask yourself, will the US government really want to do that and be responsible for trillions of dollars of household wealth being evaporated into the air, into the thin air? Are they willing to risk the political backlash from the people over there? And that's something that you really need to ponder in your head. Will tapering really happen? Or will people force the Fed to continue their bond purchases to pump money into the system, right? So we're kind of at a crossroads. Do we stay in cash hoping for a crash that might not happen and suffer the consequences of inflation? Or do we pile our money into the stock market today and continue riding the liquidity wave until it stops in mid next year? Or do we get some gold just in case to profit in case of a stock market crash, but to risk it not performing for years to come? And to be honest, right, there's no really good answers, and that is why investing is so exciting and terrifying at the same time, right? Now, as Ray Dalio said, the billion-dollar hedge fund investor and founder of Bridgewater Associates, he has a very famous clause when it comes to diversification, right? He said that diversifying well is the most important thing you need to do in order to invest well. So if you have too much stocks, perhaps it's time to think about other asset classes that are non-correlated, such as gold. And if you have too much gold, you might be missing out on serious gains if the economy continues to grow. And no one can tell the future. But if the stock market crashes and if you hold some gold, it might be a good time to transfer wealth from one asset to another. So there you have it, guys. Let me know what you think in the comments below. Do you believe that the stock market will still continue to perform well for the coming years to come? Or do you think that gold is still a better bet during these inflationary times? Let's have a conversation about this. And if you like today's video, remember to drop this video a like, hit the subscribe button. I really appreciate your support, and I'll see you guys in the next video.